Let's put that question to you. If you buy bonds, is equities essentially the only alternative, or is perhaps the equity bid a little bit more based on fundamentals? What is your take?
I think it's a mix of both. To be fair, people are always asking, what do I do with this cash? Given the inflation measures, you don't want to just stick it under the mattress. At the same time, when we look at the equity market, I do think that there is a play to be had, given especially Powell's comments on Monday that they're open to a 50 basis point hike. That's going to spur probably real yields. So you might want some of that cyclical exposure in your portfolio.
Nevertheless, if people are buying bonds, are we back into basically having to deal with Tina? There is no alternative, so we have to buy stocks. And we're in a position where, as somebody's just pointed out in an email to me, a lot of funds have mandates in terms of how much cash they can carry, Anna. So if they're selling bonds, they've got to buy something else, and they have to buy equities.
No, it's a fair point. Really, people are wondering, where do I put this cash to work? So for us, we still think there are opportunities in the equity market. And whether it's because people feel there's really nothing else, or there really are some value opportunities here, especially given the massive correction we've had in the beginning of the year. I think that there is still something to be played. Now, our price target is 47.15. It's not very much higher from here, but it's still upward and bullish. So I think if you're going to play, there is equity that you can put into your portfolio, and particularly in more the value oriented, and put a little quality twist on it as well, so that you can weather through any credit stress.
Anna, let's talk about the impact of commodities, especially. We know that margins have had a pretty good run in the last couple of quarters as you start to see a lot of these companies really pass on the cost to consumers. How long are they going to be able to do that when you have forecasts of oil hitting as high as $200 a barrel, food prices continuing to be on a tear? What's your take simply on the pressure that might be put on those margins?
Well, what we've already seen in last quarter with earnings season is that margins are under pressure. With 4Q earnings, you saw margins actually compress a little quarter over quarter, at least sequentially. But that being said, I think that some of the larger companies you saw were still able to pass along price. They were still able to grow some of their bottom line. Now, when you think about the market as a whole, though, the smaller companies did have a bit of a tougher time. So if you're worried about margins, I think that's how you can kind of defend yourself against that. Look towards the companies that have more of that pricing power. They have more size that they can kind of throw their weight around to say. But at the same time, keep in mind that even with higher prices, we've also seen higher wages. And that also helps for the consumer side.
Even the quality names in this equity market, do you think that they are going to produce returns this year that exceed inflation?
Well, when we think about quality, really where quality tends to outperform is in times where we have credit stress or you see credit spreads widening. Now, what's been interesting is with this exogenous shock with the war with Russia and Ukraine, you saw credit spreads kind of widen here, but they've also been coming in the last several weeks. You look how it was versus March, the IG credit spreads have come in from about 140 basis points to maybe 120. And on the high yield side, you saw that shrink from about 400 basis points to 350. Those kind of moves are telling you that there's still risk appetite and credit is still healthy in the U.S. at least.
Okay.
So those are signs that, yes?
Are equities going to outperform inflation this year?
I think for us, look, again, our price target is up about 5% here. So if the Fed really continues with a more aggressive rate hike schedule, I think they still have a chance. But at the same time, it really depends on if the Fed can maintain that aggressive schedule that they do and really bring down inflation and grab inflation and face it head on.
Anna, it seems like there is a lot of meshing of this idea that decelerating growth could very easily turn into demand destruction and then ultimately a recession, creating a very bearish view for stocks right now. What's your take simply on the possibility of a recession, the possibility of demand destruction, and to your point earlier on wages, how much the American consumer and American companies can actually weather that storm?
Well, so far, what we've heard from corporates and on the corporate side in earnings is that they are pretty healthy. They are still seeing, earnings growth, and we do expect, at least for the S&P 500 companies, that EPS growth will continue to be positive. Now, that is our base case scenario. Something we have to consider is what happens if this war really spreads and China gets involved. U.S. has a lot more exposure with China, so if they get into this mess and we end up in a situation where perhaps we need to put sanctions and corporates in the U.S., again, more exposed to China get involved. Now that could be more of the tail case scenario, but it's something to consider, and that could push us more into dangerous territory. Something to keep in mind as well that people are watching is really the yield curve. And when you see that yield curve flattening and the potential for it to really invert later in this year, that too is something that kind of in the back of people's minds, people relate to a recessionary scenario. And then keep in mind as well, with rates at where they are now, the Fed is raising them. But to have the power to cut and ease on a monetary, we first need to raise rates. So I think that too, those monetary tools being where we are, bring a little bit of concern that if we were to get into that territory, we don't have as much ammo really to help ease markets again.
Anna, how much of the gains of the last few years have been driven by central bank delivered liquidity? And if that liquidity is going to be withdrawn, can't we assume that the opposite will happen?
Well, I think already the market priced in some of that. You saw as we started expecting rate hikes, the market kind of started to slow its upward pace, especially in the beginning of the year. Even before the situation with Russia and Ukraine, you saw the markets were falling and kind of pulling back as we priced in that expectation of monetary tightening. And you're absolutely right. I think monetary easing on top of that fiscal stimulus was really a big driver of equity returns in the past years. So we're going to have to get used to not having that support and really the training wheels coming off the bicycle.